Hello, welcome to this presentation on financial reporting analysis aimed at helping you pass the CFA Level 1 exam. Let me just introduce myself before we go any further. My name is Simon Holohan. I'm the head of CFA program exam training here at Fitch Learning. And I've been preparing candidates for the CFA exam for approaching 20 years now. So I've got a lot of personal experience of the exam and the challenges which it will cause for you sitting the exam. I'm obviously part of a team here at Fitch Learning. We have a number of CFA instructors all over the world, and you know, collectively we have an awful lot of experience. So hopefully, with my personal experience and with all the cumulative experience of our faculty, I can help you with this this session. So it's just going to be a fairly focused and fairly hopefully short and useful session. Obviously not trying to address the entire topic of FRA, but looking at just one specific area, and that's going to be accounting for long-lived liabilities, such as a bond or maybe a lease. Okay, but before we go through that, I just want to introduce Fitch Learning to you. Some of you may not have used us or heard of us before. We have been going for a very long time, although admittedly for the first sort of 10, 12 years we were called Seven City. We were acquired by the Fitch Group in 2013 to create Fitch Learning. And we've prepared thousands, I mean literally thousands of candidates a year to help them get through CFA. If you do feel you need a little bit of extra help just to get you over that finishing line, obviously time is moving on, the exam is only a couple of months away, we do have a range of study options to help you, whether it's a classroom course, and we do have a couple of versions of those which you'll see in a moment, or just access to our online platform. You can have access to the whole platform, which has the entire video library, or just access to the final review part, which really has the mock exams and a really cool question generator. It's up to you, but we have a lot of resources to help you. Just a word, if I may, about the online platform. We call it Cognition. It is an unbelievably clever, intelligent platform, which is truly adaptive. So what that does mean is that you will all get an individual experience. And what I mean by that is there's an algorithm running behind it which tracks everything you do. Every question you answer, it'll track your score, you know, was it right or wrong. It will even track the time you've taken to answer it. And it will benchmark your performance with everyone else. Now, some questions have been in the curriculum for several years, so the chances are that question has been answered by thousands, maybe tens of thousands of delegates. And we have all that data, so we can benchmark you very accurately. So the algorithm has a pretty good idea of your strengths and weaknesses. And then when you come to do like a little mini test, we call them knowledge checks. But this is a truly tailored test based on the algorithm's profile. So, you know, the test will cover, you know, a fairly condensed part of the curriculum, right? And if you are a very, very confident and strong candidate who has got the previous questions correct, the algorithm thinks, yep, you're one of the best, then you might find that test will only involve 12, 15 questions. If you're someone who's perhaps found the topic a little bit more challenging, you may find the algorithm will send you 20, 30 or 40 questions. The point is, it'll give you the appropriate number of questions for your profile in order for you to learn and remember those concepts. So it is very, very clever. I'd recommend, if you get a moment, to have a look at it. And it certainly is a valuable resource with hundreds of hours of videos and thousands of online questions. In terms of classroom courses, we do have a variety of courses here. So we have a 5-day intensive program, which is kicking off, in fact, 2 of them kicking off shortly here in London. As the name suggests, it is an intensive, content-focused program, 5 days, trying to go through as much of the CFA curriculum as we possibly can. Obviously, it relies on you having done some studying beforehand. That way we can cut through some of the more straightforward stuff and focus on the very, very exam relevant aspects, and maybe some of the more technical aspects as well. We also have, as you can see throughout the world really, 2-day review classes. This is not so content focused, this is more exam focused, exam technique, exam preparation. It's really 2 days of question and debrief, and all the questions will be done under the exam timing. Okay, so you can see a whole range of locations we have here. For details of dates, obviously please have a look at the website. And as I mentioned a few months ago, we do have an online aspect which is just the review part. So if you don't want all the videos of instructors like myself, teaching you various content, if you just want to do the last part, the mock exams, and prepare for it, then you can use the online review part, which will have several mock exams and say a really cool question generator tool. So you can almost make your own mock exams. You can target it at a study session. You can even drill more and target it at a reading. So within a study session, you might realize that one reading is weak. So you can just ask for questions on that reading. Anyway, so please, if you have any queries about what we can help you with, please reach out to us. You'll find contact details at the end of this presentation. Okay, well, that's enough about us. Let's move on to talking about FRA. So as you know, it's an important topic weighting. It's 20%. And the reality is you have to score at least okay in FRA in order to pass the exam. If you're getting below 50% in FRA, given it's 20% of the exam, it just becomes really difficult to pass the exam. It's very hard to move your average score sufficiently high enough to get to the passing score. So you need to sort of be honest with yourself and do as much time as you need so you can consistently be getting, let's say, at least 50 to 60%. If you can get 50 to 60 in this area, you can push up your average score by getting maybe 75 or 80% in some other topics. But you want to be aiming for at least 50% here. Ideally, obviously 70, but for some people, this is a challenging area. Okay, so for today's little session, I'm going to be looking at study session 8, reading 31, so looking at long-term or non-current or liabilities. And we're not going to be looking at the whole reading, but we're looking at 2 areas which are very connected, as you'll see. One is on accounting for a bond, and one is for accounting for a lease. Okay. And along the way, I'll show you a really useful shortcut with your calculator, which you really have to be all over, as I'm sure you know. This wonderful Texas Instruments BA2+. Okay, before we look at the accounting for a bond, there's a little bit of background knowledge which you are assumed to know regarding bonds. Okay, obviously you probably covered fixed income, I guess, by now, so you might know this already. So let's just go through sort of the anatomy of a bond. Right? So a bond will have an income. I'll say will have an income. The ones we look at in accounts have an income. Obviously, not all bonds have an income, but we're looking here at fixed income bonds. So the income, which is known as the coupon, is a fixed cash flow. Okay. Now, in terms of dollars, the actual amount that you get in dollars will be based on the coupon rate times by the par value. The par value might be called the nominal value, or the face value, or the principal, different names for the same thing. So we'll be looking at a fixed coupon bond. And obviously in our calculator, and that's what we're going to use the payment button for. Okay. So the coupon, the cash flow is the coupon. The par value, as you can see, drives the cash flows. Right? The par value also, however, is important because it determines the amount you get back at maturity. Right? So the par value is paid back to the investor at maturity. So the par value or nominal value has two very important aspects. It's the cash flow you get at the end, and it also drives the income you get in the meantime. So if you issue a bond at par, okay, which is the normally trying to issue a bond at par. So let's assume the par value is 100, okay, so the selling price is 100. That tells us that investors are happy with the coupon. The coupon rate is the same as the yield they require. So the yield at issue, or might be called the required return, okay, or maybe just use the word yield. Obviously, the yield at issue is the yield that was required by investors when you issued a bond. So if the price is issued at par, it means investors are really quite happy. The coupon rate, let's say 5%, is the rate they need for that particular maturity, that particular currency, that particular issuer, whatever factor you want to analyse. What about, however, if the coupon rate was, let's say, lower than the required yield? So imagine the coupon was 2% and investors required 5%. Well, obviously, they're not getting the return they need. They're only getting 2% through the income. So therefore, investors have to manufacture an extra return in the form of the maturity proceeds. So what they'll do is they'll say to the issuer, right, we're not willing to pay 100 for that bond. Instead, we might, let's say, only pay 90. Right? But the par value, we still want to be 100. So in other words, they're saying we want to make a gain of 10 at maturity. And if I average that gain of 10 over the life of the bond, then that will push up my average return up to my required return. So I could be getting 2% through the income. I'll get a further, let's say, 3% through this gain at maturity, and that will give me my 5. So when you issue a bond below the par value, in CFA speak, we call that being issued at a discount. The discount being 10 here. Okay, and similarly, we could issue a bond above par, which we call a premium. Okay, so really, we can think of the investor's return, its yield, as being made up of the income, the coupon, plus or minus this discount or premium. Now, of course, a yield is always quoted as an annual figure. You know, it's my required returns. It's always an annualized figure. The coupon is annualized. But this gain or loss, this discount or premium, is just like in my example 10. So we have to average it out. Okay, so I think so. It's the average of the. Perhaps I'll use the word discount rather than gain. So it's the average of the discount or premium. Okay. Now, when you average out an amount of money, a better, more accounting-specific term than average is amortization. So you might see reference to the amortization of the bond discount or the amortization of the bond premium. Just in plain English means you're averaging out the gain or loss you make on maturity. So, okay, I've got a coupon of 2, I've got a gain of 10, I'll average that out over the life of the bond such that I end up with the required yield of whatever it is, 5%. Okay, so there's a little bit of assumed knowledge for fixed income, hopefully nothing too challenging. I should add, by the way, if any of you wish to send any questions in, you can type any questions. I've got a computer screen in front of me to the side. So if you see me looking to the side, it's because I'm checking anything coming in. And I'd be happy to deal with questions if I can, here and now. If not, I'll have to do that offline. Okay. Right, so back to the accounting. So we should be okay with bonds. You know, par value paid back at maturity. Par value drives the coupon, the cash flow. Yield is made up of the coupon, the cash flow, plus or minus any gain or loss made at maturity. Okay, so let's go through an example. So we're going to issue a bond. Okay, at time 0, the bond goes into the balance sheet based on the present value of the bond's cash flows, or the price of the bond, or the issue proceeds. Doesn't really matter. Yeah, one person's price is one person's proceeds. So that's what goes in. So we ought to be able to get to this number. It's going to be the PV of future cash flows. Obviously, our calculator can do all the heavy lifting for us. Okay. So, okay, an issuer borrows money. So imagine I issue a bond, you give me 100, that's me borrowing 100. If I don't make any payments back to you, the size of that debt will rise, because if you require a return of 10% and I don't make a payment, then the only way you will get that return is for me to pay back more. So, you know, whatever I borrow, the liability will be rising. When I make a payment, the liability drops back down. So the liability will move in our accounts based on the interest expense less the payment. Okay. Now the payment is that coupon which we spoke about a moment ago. The interest expense is based on the yield. It's the yield at issue. Right? You will undoubtedly get questions where they talk about like a 5-year bond and they give you the yield when it was issued, let's say 5%, and then they say, right, 2 years later, you know, current yields are 8%. And they ask you, what is the interest expense in year 2? Well, we don't care about current yields. The only yield you should worry about is the yield when the bond was issued. So it's really important you highlight that, yield at issue. All other yields are irrelevant in this accounting method. I say this method, this is the main method you're lucky to see for the average corporate. There is an option to do fair value accounting. It's mostly done under IFRS with banks, to be honest, but it's an option. So you could have a fair value approach. Obviously their current yields will absolutely affect the value of bonds. I'm not going to cover it today. It's a really small part of the curriculum anyway, and I really don't want to give it undue emphasis. So this is what we're going to stick with, the cost approach, right, which is by far the more common one anyway. Okay, so you have your present value of future cash flows is your issue proceeds, opening liability. The interest expense is based on the yield at issue multiplied by the opening liability for that year. So the year 1 interest expense will be yield at issue times the opening liability of year 1. The year 2 interest expense will be the yield at issue times the opening liability for year 2, and so on and so on. Okay, and then that will give us our closing liability. All right. Now the coupons, the payment, whatever, obviously this is a cash flow, so we should be familiar with where this cash flow goes. So interest paid, as a quick recap, you may recall there's a difference between US GAAP and IFRS. So US GAAP says interest paid must be CFO. IFRS says you can do the same as US GAAP if you want, or you can reclassify. And IFRS likes interest paid to be put in the same category as dividends paid. So basically you either put interest paid and dividends paid into CFO, or you put interest paid and dividends paid into CFF. Right? So the coupon, the payment, is a cash flow. The interest expense part, that's going to be coming through the income statement. So that's my expense income statement. Okay, so it's important we can kind of pull out the right numbers here. Okay, so let's do a little example with numbers. Okay, here we have a 3-year, okay, annual coupon bond. So 3 annual coupons, so obviously 3N. Excuse me. The face value, another word for par value, is 40,000. Okay, so that's what we get paid at maturity. The coupon rate is 8%. Okay, so we can easily work out what the coupon is as a dollar cash flow. That'll be 8% of the par value. So 8% of 40,000. which gives us $3,200. Okay. The market interest rate, well, that's the interest rate required by the market at the time of issue. So that's my yield, is 9%. So what we haven't got initially is the opening present value. It's quite likely in these questions you don't have one important number. So here we don't have the opening PV, the opening liability. But maybe next time they give you the issue price, and what you don't have is the yield, so you can back out the yield. Or maybe you don't have the coupon, you can solve for the payment. You know, we should be okay with a calculator by now in terms of working out one of those unknowns in that third row. So okay, here the unknown is the present value of the cash flow. So okay, turn on my calculator. Okay, first up, clear the time value of money. So second FV clears that. Now we can input the details, obviously in any order. So 3N, 9I/Y, 3,200 is the payment, 40,000 is my final value, compute PV. So I'm just going to do that with you. So 3N, 9I/Y, 3,200 payment, 40,000 FV. Now before I click compute PV, it's worth to have a sort of reality check. The coupon rate is lower than the yield. So investors need a return of 9, they're only getting 8. So they're going to have to manufacture some extra return in the form of making a gain at maturity. So I'm looking for an answer, a price below the par value. So compute PV, and okay, what do I get? I get 38,987.48. Okay, that smells right, doesn't it? And we're thinking, okay, I need to get a little bit extra. I need to get an extra 1% from somewhere, an average of 1% a year. Okay, I'm getting 8% coupon. I need 9%. So if I buy a bond, okay, let's round it. It's called 39,000, and I hold it to maturity. I get 40,000. So I get 1,000 gain from an outlay of 39,000-ish. Well, that is in percentage terms, that's about 2.5, 2.6% over the 3 years. Okay, I need to average it over 3 years. Okay, so you know that's obviously going to, if I divide it by 3, it's going to be coming in at about 0.8, 0.9%. Okay, but then not only do I have to average it, I've got to allow for the compounding effect over 3 years. So that's why it's not going to be quite as simple as just the gain divided by 3. But anyway, it does smell about right, doesn't it? It smells right. Had the answer come up with like 30,000, then clearly we'd know we've made a fat finger error. Because making a 10,000 gain and having spent 30,000, that's a third, that's a 33% return. When you average that over 3 years, you're going to get nowhere near 1%. So just have a reality check before you go further. Okay, so there's my price. So that's going to be my opening liability. Here we are at time 0. So the interest expense would be the yield at issue times the liability, the opening liability for that period. So I want 9% of the opening liability for year 1, which we have there, 38,987. So that will give us 3,509. So remember, we have our opening balance plus interest minus payment equals closing. So okay, so 38,987 plus 3,509. Take away the cash payment of 3,200. So 38,987 plus 3,509 minus 3,200, and we end up with a liability of 39,296. So that liability is slowly creeping up. It has to creep up because when we get to the end of year 3, this liability needs to be 40,000, because my last transaction will be to pay back the par value. So my last double entry will be cash down 40, liability down 40. So that liability is slowly going to sneak its way up towards 40,000. Okay, let's now do the second year. Okay, so now still 9%. Remember, that yield doesn't change. But now the opening liability for the second year is 39,296. So that gives me a interest figure of 3,536.6. Let's call it 37. Right, there we go. The payment is still 3,200. Okay. So again, we can do our opening liability, 39,296, plus interest, 3,537, minus the payment of 3,200. Again, we're looking for an answer that's slowly increasing. I say increasing, it's moving the liability towards par. Had we started above par, okay, it will be decreasing. But it has to be getting closer to the par value. So I get an answer of 39,633, which seems about right. That then becomes the opening for year 3. Okay, so times that by 9%, we get 3,566.9, let's call it 67. Take away the cash flow, and okay, I have rounded a little bit along the way, so it's not going to exactly be 40,000, but if I didn't round, it would be there. Okay. So with a 3-year bond, that didn't take too long, and so if I asked you, what was the interest expense in year 2, we can see the answer is 3,537. So remember that interest expense, this column we have here, is what we're going to see coming through the income statement. So as a cost, 3,509, 3,537, and 3,567. The cash payment, we said, is what's going to be coming through the cash flow statement. Either CFO, if it's a US GAAP, it must be CFO, or CFO stroke CFF if it's IFRS. Don't forget the last cash flow I mentioned earlier. The very last cash flow is, okay, we pay off the par value. And that last cash flow will be a financing cash flow for both US and IFRS. So the very last double entry, cash down 40,000, CFF, liability down 40,000. Okay, so here we have our three-year example. It's not too onerous. However, had this been a 33-year bond, and I asked you, what was the interest expense in year 25, you're not going to be doing this 25 times. Well, I hope not. There's a much shorter way of doing it. It's a fantastic shortcut in your calculator, and that's using the amortization function. Because that's what we've done. We have amortized this discount. We've moved it, averaged it, we've spread it, whatever term on you, over the 3 years. So if you look in your calculator, third row from the top, middle of the third row, you have the present value, the PV button. Well, above that in yellow, you have the words amort. This is the function we're going to use. So let's press second and amort, which is the PV button. Okay. Now, for this to work, the calculator has to know all that time value of money information. So in other words, you have to have done this calculation early on and not wiped the memory. So compute the PV. Hopefully you've still got that number in your calculator and you haven't on autopilot press second FV straight away. If you have, redo the calculation. Now I haven't wiped mine. My PV will still be 38,987. So I can press the second amort function. You'll be asked for P1 and P2. Well, P1 is basically the time period you wish to start analysing, calculating, and P2 is the end. So start and end. So if you just want to analyse the first year, year 1, then P1 and P2 will be 1. If you want to analyse year 2, then P1 and P2 would be 2. If I asked you what's the interest expense for the first 2 years, then P1 is 1, P2 is 2. So let's as an example, let's do that year 2 interest expense. Okay. So I only want to analyse year 2. So when it says P1, let's type in 2, hit the enter button, as you're probably familiar by now. That's how you kind of put information into these worksheets. So press 2, enter, then the down arrow, and that moves on to P2. So P2, we'll go for 2, enter, and the down arrow. Okay, so 2, enter, down. The first value you get is the balance. So that is the year 2 end balance. So I get here 39,633. Okay. Well, that's what we had here. 39,633. That's my year end balance. If I press the down arrow again, I get PRN, principal. That is the movement of the liability in that second year. So that liability has gone from 39,296 to 39,633. So that movement is the principal. But that wasn't the question. I asked for the interest. So press the down arrow again, and there we are, interest. And we get the answer of 3,536 points. Let's call it 3,537, something like that, bit of rounding. So 3,537, there we are, tick, got that. So this amortization function, I think it's one of the best functions on the calculator. It can save you heaps of time, because what we did in the long method is great for 1 year or 2 year, but you're simply not going to be doing that for a 50-year bond. So if I asked you what's the interest expense for year 25, P1 25, P2 25, down, down, boom, there we are. So really, really important, get used to that amort function. But before you can use that, you have to have done the time value calculations. Doesn't matter which one. You could have, here we computed the PV. Maybe next time I gave you the PV, you compute the yield. Doesn't matter, as long as the calculator has the information about the time, the cash flows, the yield, the price. If it has that information, it can do the amort function. Okay. So there's our final solution we have here for that discount. Okay. If you issue a bond, oh, by the way, here's the calculator steps, so which we went through, a sort of neater version of the calculator. This is showing how to work out the value for year 1. So for year 1, you have P11 and P21. For year 2, P12, P22, etc. Okay. And again, I won't go through it today, but here's another example. By all means, have a look through when you get a moment of a bond issued above the face value. Why? Because the coupon is really high. The investors only need a return of 6%, but you're giving them 8%. Now, there's no such thing as a free lunch deal. So if you've got a cash flow that's really too high, then I'm afraid the price you pay is you'll suffer a loss at maturity. So you'll end up buying this bond for whatever, say 42,000. I'm just making up a number here. And at maturity, you get back 40, so you lose 2,000. Okay. But again, have a go, and have a go at that amortization function in particular. You ought to be able to get all of these numbers you see here from that amort function. So brilliant function, brilliant shortcut. Hopefully there's no questions. If there are, remember, just type them away and I'll do my best to answer them. Okay. Right, so there's liabilities done. Okay. Let's now think about a lease. All right. Now, a lease is a rental agreement. You're renting an asset. There are two types of lease. You have an operating lease, which was originally designed for a short-term lease, short-term contract. Over the years, the criteria have allowed some abuses to happen. So there are many companies out there who have operating leases which aren't particularly short-term. So as we've seen when we look at the criteria, it can be abused to an extent. IFRS, I think, is changing the criteria, but that's not examinable for the CFA exam until next year. So the slides we're looking at today are absolutely accurate for the CFA exam coming up in December of 2018. But if we're talking about the 2019 exam, we'll just change it a bit. But anyway, enough of that. An operating lease is meant to be a short-term contract, and it's treated just like a simple rental. You go and hire a car, you hand over $1,000, you get the use of a car for a few days. At no point would that car ever be on your balance sheet. At no point would you think of that car as being yours. It's just a very, very simple transaction. So $1,000 is your expense through the income statement, and $1,000 is your cash flow through CFO. So very, very straightforward. No asset, no liability on the balance sheet. A finance lease, which is also called a capital lease, by the way, two words for the same thing. This is where you're still renting, but because you're renting the asset for so long that economically, to all intents, it's your asset. And remember the definition, if you go back to Balance Sheet 101, the definition of an asset is anything you own or control. So if I hire a car, the same car, for 7 years, I've pretty much controlled that asset for its useful economic life. So although I don't legally own it, and this has got nothing to do with legality, by the way, although I don't legally own the car, economically I do. And therefore I will put that car on my balance sheet as an asset. And the way I treat it, when someone asks me, well, where did the money come from to buy that car, I'll view it as a loan. So effectively, the car hire company has given me a loan. With that money, I bought a car. So I have a liability and an asset. And then the rental payments I'm making will be equivalent to me repaying a loan. And note, I'm repaying a loan, all right, and that loan will start at a certain figure and go down to zero. Right, so it's a repayment loan. It's not an interest-only loan. I'll pick up at that point in a moment. Okay. So I will, the point is, have an asset and a liability recognised on the balance sheet. Okay. Now the liability, that's easy, just done that. So the liability part of the lease is as per the bond. Same thing, use the amort function, same structure. The asset, well, you probably have covered that by now, how to account for assets. We're talking here about physical, tangible assets. So they are depreciated. And again, in the CFA curriculum, they tend to use straight line depreciation. So I would assume that if you're not told otherwise. So there's actually not a huge amount of new content here. This is why these two topics go so well together. If you can account for a bond, you should be able to account for at least the liability part of a finance lease. Okay, let's have a look at the criteria before we go through an example. So IFRS criteria for is it a finance lease? Now, please bear in mind, just one of these is sufficient. So note the word or at the end. It's not all of them. So if the ownership of the asset transfers at the end of the lease term. So you hire a car for 7 years. The car hire company says, you know what, we don't want it back. Don't blame them actually. After 7 years of with my kids and dogs jumping in and out, it's probably, you don't want the car back. So they're saying that's yours, you dump it, you dispose of it, give it to the fire brigade to practice on, whatever you want to do, but we don't want it back. So that's a finance lease. So that's one criteria. Or you have an option to buy the asset, but crucially to buy it at below its expected fair value. Okay, so we often call it a bargain purchase. So it might be a case of you hire a car for 7 years. At the end of the 7 years, you can buy the car for $1. Okay. Third one, again, or you lease the term for a major part of the asset's life. Okay, major part. Now, even that, you'll think the word major is pretty straightforward, but you'd be surprised how many people can argue the toss on what is meant by the word major, which is why you'll see US GAAP has a clear definition of major, which obviously has strengths and weaknesses. You know, we have a clear definition, then you basically told people how to game it, but at the same time is a clear definition. Anyway, these are our IFRS criteria, so any one of these makes it a finance lease. For US GAAP, the first two are as per IFRS, so ownership transfers at the end, and you can buy the asset for below the fair value. But look at the other criteria. So rather than using the word a major part of the asset's life, US GAAP says, okay, at least 3/4 of the asset's life. So that's good and bad. I mean, it's good in that you're taking away all doubt. That's it, 3/4, that's the benchmark. The downside, I guess, is if you wanted to game it, you could have a lease arrangement which is for 74.99% of the asset's life. You know, and that's always the problem with these clear-cut definitions. They're great for transparency and clarity, but you probably could game it if you wanted to. But anyway, there's our major part of life. And then the fourth one is a new criteria for US GAAP versus IFRS. If the present value of the lease payments is at least 90% of the fair value of the asset. Now you find, as you can imagine, the CFA questions will be testing right at this very edge of the definition. And you'll be thinking to yourself, oh, is it more than 90%? Is it 90% or more? You know, or is it more than 75% or 75% or more? So please make sure you do learn the exact precise criteria. So for the life expectancy, it's 75% or more, and for the present value of the payments, it's 90% or more. It's not more than 90%. Okay, and before we do an example, for those of you with good eyesight, you'll see there's a little asterisk after those two, which basically alludes to the last point down the bottom. Excuse me. So those last two criteria cannot be used in the final 25% of the asset's life. So imagine you go into a car hire shop. You say, I want to hire a car for 1.5 years. And the guy behind the desk says, well, I've only got that knackered old car at the back. It's already 6 years old. You'll say, fine, I'll take it. But he'll say, yeah, but it's 6 years old. It's only got 2 years left until it gets scrapped. You'll take it, fine. Okay, so you've got 1.5 years of the final 2 years. Okay, so that's clearly 75% of the asset's life. But you started that lease in the final quarter of the asset's life. And then hence that length, that 75% rule becomes non-valid, okay? So just watch out for that little bit of detail. We have those last two here, okay? Right, let's have a look at an example. Again, there's not too much for us to do here. We've seen some of it before. So we're going to look at a finance lease, which will recognize an asset on the balance sheet, and that asset will then get depreciated, typically down to 0. And of course that depreciation expense is coming through the income statement. And we have a liability, and that liability will amortize down to 0. And we know from the amortization that the interest part is coming through the income statement. So when we compare an operating lease with a finance lease, an operating lease will have just the payment, the rental payment, as an operating expense. A finance lease, you won't see as an operating expense that payment. What you'll see instead is depreciation and interest. Okay. The liability, we said, is as per what we've been talking about just a few months ago for the bond. So let's have a go with some numbers. here's a lease. It's an arrangement for 4 years. It's going to be for $1,000 a year due at the end of each year. The interest rate is 10%, and the life of the asset is 5 years. So 4 out of 5 is 80% of the asset's life. So under US GAAP, definitely a finance lease, because we are at least 75% of the asset's life. Or for IFRS, we've leased the asset for a major part of its life. Okay, so there's our, we know it's a finance lease. Okay, what we need to think about though is now what is the present value of this lease. Right? We need this for 2 reasons. Firstly, if I want to use the amortization function on the calculator, I need to do this calculation. And secondly, it's important because it helps us determine what is the opening value for the asset and the liability on the balance sheet. Because the opening value would be the lower of the present value of the lease payments or the fair value. So we have the fair value, I need the present value. So let's work this out. Again, so second FV to clear the time value formula. Then it's 4N, 1,000 payment, 10 I/Y, compute PV. So I've got 3,169.8, I'll call it 70, okay. So the present value of lease payments is roughly 3,170. The fair value is 3.5, so the lower of those two we're going to put on our balance sheet, okay. So that's easy. So we've got an asset on our balance sheet at time 0 of 3,170 and a liability at time 0 of 3,170. Now the liability will amortize down to 0 as per a bond, as we looked at earlier, and the asset will depreciate down. We're going to spread that cost. There's no mention of any scrap value, so the depreciation will just be the historic cost, if you like, minus no scrap value, over the life, which is 4 years. So 3,170 divided by 4 gives us 792.5. So that's our depreciation. Okay. If it's an operating lease, we said that's easy. We'll have no asset, no liability, and on the income statement, all we'll see is a $1,000 expense. And on the cash flow statement, we'll see $1,000 as an operating cash flow. Okay, so very, very simple for an operating lease. Right? But it's the finance lease we need to think about. Okay, so we've got depreciation each year, 792.5. What we now need is to use the amortization function to pull out the interest expense. We need both of those to see how we account for it on the income statement. So again, here's the solution to that example, but I'd urge you to have a go at the amort function. Yeah, so I know I'm just going to have a go at year 3 here. So I've already calculated the present value of the lease. So I'll go for second and then the amort, which is the present value button. It'll ask me for P1. So I'm going to say I want to analyze year 3. So start of year 3. So and type in 3, enter and down. It will then say P2. I'll also go for 3. So I want to basically start and end at year 3. 3, enter, down, 3, enter, down. The first thing I get then is balance. There we are. And the balance on my calculator is 909 point something. Okay, we've rounded it to 910. Hit the down arrow again, we get the principal, okay, which is the movement in the liability. Hit the down arrow again, and there we are, we get interest. Okay, the exact answer is 173.55. Okay, we've rounded to 174. So if you get a calculation question, it could well be like that, where you get a little bit of a lease type of information, and they could ask you what is the interest expense, let's say in year 3. So that amort function is very useful. Okay, very useful. So here's our concluding income statement, sets of accounts. We said for the operating lease, we're going to have just $1,000 per year as an expense. Okay, whereas for a finance lease, we're going to be showing depreciation and interest. Depreciation was 792.5. Okay, so to avoid decimals, we rounded up for 2 years, rounded down for 2 years. Right? Now, if you add up the depreciation along with the interest, you'll find for year one, you get a little bit more than 1,000. So, 1,110. But for year 4, and 3 in fact, you get a little bit less. When you combine them all, clearly you get the same. Both of these will cost 4,000. Right? But just watch out for questions that might ask you about the early years versus the latter years. So you get a slightly higher cost in the early years, typically for a finance lease. Now, I mentioned cash flow before we finish. Something else I want to pick up is the cash flow for a finance lease. So here we have our finance lease, okay, and with that cash payment we have is 1,000. But I did give you a bit of a warning beforehand. This is treated as a repayment loan. So I have a mortgage, I have a repayment mortgage, and every time I make a payment for my mortgage, that payment is a bit of interest and a bit of principal. Whoops, can't spell. A bit of interest and a bit of principal. And we should know that interest and principal are classified differently in a cash flow statement. Certainly under US GAAP, okay, may not be under IFRS. So interest under US GAAP must be CFO. Principal under US GAAP must be CFF. IFRS, interest paid, could be CFO or could be CFF. Principal must be CFF. Okay. So if you take that first payment in year one of 1,000, well, we can see the interest is 317. So you've got 317 as an outflow. Let's go for US GAAP because these are dollar numbers. So 317 is an outflow for CFO, and the balance 683 is an outflow under CFF. And if we contrast that with an operating lease, the entire 1,000 would be an operating cash flow. So, we've done the income statement here. Let's just remind ourselves of the balance sheet then. So, and I'll do US GAAP here. So, CFO would have an outflow of 317 versus an outflow of 1,000. So, we're doing our operating lease and my finance lease. Yeah. In terms of the principal, okay, we'd have an outflow of 683. There's no principal for an operating lease. So again, in terms of total cash flow, clearly 1,000 equals 1,000. But if we ask you about the breakdown, we can see that with a finance lease, because you've got a lower outflow, you end up with a higher balance for CFO, but then the opposite applies for CFF. Okay. So now you're okay with some of the numbers. The summary should make sense. Yeah. And I must say, yes, you may get a question like the numbers we did earlier, but I think you're just as likely, if not more likely, to get these kind of true or false type questions. So would this part of the accounts be higher or lower? Or maybe would this ratio be higher or lower? So I think this slide and the next slide probably are the more important of the two. So let's just make sure we can tick through this. So a finance lease, capital lease, at the start of the lease in particular, you have higher assets because we have an asset on our balance sheet and a liability. Now clearly by the end of the lease, the asset has gone down to zero. So I guess the question would probably assume that we are at the start of the lease or near the start. So we have an asset and a liability. Okay. Income in the early years, well, we've proved that with numbers, is lower Yeah? So we had a cost of 1,000 for an operating lease versus the cost of 1,110. Yeah? But over the 4 years, the total cost is the same, 4,000 each type of lease. We've gone through CFO, so only got 317 as an outflow for a finance lease, as opposed to 1,000 for an operating. But then we do have an outflow for principal, which we don't for operating. And in terms of ratios, again, really important slide here. Now, clearly we haven't included all the ratios, but I would urge you to think about all the ratios in the curriculum and just think about how would a lease decision to switch affect the ratio. Obviously, profit margin, that should make sense because we have lower profit in the early years, hence lower profit margin. Asset turnover, we have higher assets for a finance lease, hence we have lower asset turnover. Current ratio, now watch out for that, that often gets forgotten. With a current ratio, you've got current assets over current liabilities. Now the numerator, there's no effect here, okay, because we're talking here about long-term assets. But there is an effect on the denominator. This is a repayment loan. So it's not like the debt is all going to be just left until the end. Each year we are paying some of it back. So there will be an element of that liability which is paid off in the forthcoming year, hence a current liability. So do watch out for that. Apart from that, the other ratios hopefully should make sense. Return assets, okay, you got lower net income, true, but the big effect there is on the assets. You have much higher assets with a finance lease. So your denominator is the main effect here, higher assets. Okay, net income a little bit lower, but I would focus on the assets to get lower return assets. So yeah, so hopefully this session has been useful, and hopefully you've learned something about the topic, maybe something about Fitch learning. And so if you do need any extra help, please reach out to either Jennifer or Steve, and they'll be able to discuss the help we can give you to get you through the CFA exam. Anyway, thank you for listening and watching, and good luck for the exam.